Welcome to the weekly update, where I'll go over the action in the market for the week of April 10th through the 14th, and then we'll see how things look for the week of April 17th through the 21st. We had another up week, not really solid, but it's helped our charts to improve quite a bit. So we're looking more positive on the weekly charts, and that's also carrying through from the daily charts, which are also looking positive, albeit we're pretty much short-term and even intermediate-term overbought. Over this weekend, I did a lot of research with bonds, and I have a lot of extra charts to show you with some bond studies on them, because that's what's really making a lot of the financial press right now, are people getting into bonds because interest rates are going up. They're looking more attractive. The economy appears to be weakening, so bond prices could go up, and that would push interest rates down. And so people are seeing bonds as more attractive right now with the higher yield, fearing that down the road, the yields are going to be much lower. Before I get started on the video, I have a couple of things to talk about. Number one, from April 22nd through May 11th, I will be traveling. I intend to do the daily videos during that time. It's not very likely, or I'll really try, but I'm not very confident that I'll be able to do the weekly videos as well as the intermarket analysis video and the deep dive video. I'll try, but I can't really guarantee that. My goal is to at least to try to do the daily video and then the other videos if I'm capable of doing that. I do have a podcast now that's on the YouTube channel. It's a carbon copy of what you're seeing right now. And in the podcast, as well as each video, there is a PDF of all the slides and charts that I use, so you can follow along as I go through these different charts. I do have a private Facebook group that you're welcome to join. There's a link in the description, or send me an invitation on Facebook. I do have a poll that's posted, and I'll be going over the results of the most recent poll, and then I will also be launching the poll for the upcoming week. I also post the pivot points, and I update that every day on the community tab, and those are often very key support and resistance levels. Let's go back and talk about what happened. The S&P was up 0.79% on below average volume. That is a concern. Overall, we've been going higher, but we're seeing a decrease in volume. The technicals are mostly positive on the weekly chart. There's a few things to be worried about, as there always is. And the markets are really fixated on this inflation and interest rate scenario. One thing that I have here, but I didn't highlight in gold, is earnings season is getting ready to start, and that can have a real impact on the market. And then any Fed speak that we may get. Our trend is still going down overall. The ADX is declining. It's below the moving average, but the green line's on top, so we do default to the positive trend. And we're seeing pretty much that same thing on the daily charts. Over on the right-hand side, I ran across this interesting comic that you can stop and look at. I thought that pretty much described how things went over the last week. For the week, all major indices did register gains. There are still concerns about inflation and interest rates. Bitcoin was able to get back above 30, and so far it's still above that. Volume continues to be below average. And earnings season, as I said, is now beginning. Looking back over the week, on Monday, the stock market declined, but then bounced later in the day to recoup a lot of the losses. Pretty much finished unchanged, but it was still impressive. On Tuesday, the stock market held up on light volume. That was ahead of the CPI that was coming out. On Wednesday, CPI did come out, and it was taken as positive, but the core CPI was actually up a little bit, and that ended up kind of freaking out the markets. The S&P fell below 4,100. That brought in a lot of buyers. So we're seeing support when we do fall and a lot of buying coming in. That's positive. And then we also had the FOMC meeting minutes that were released later in the day. They came out and said that the people on the FOMC agreed that inflation remains too high and that the banking problems increased economic uncertainty. All of the people on the FOMC agreed that it was appropriate to raise rates even though the economic outlook included a mild recession. And to my knowledge, this is the first time that the Fed ever said that in their notes. And they think that it will start later this year, given the potential economic effects of the recent banking sector developments. And now we're trying to wonder, are there going to be more developments in this whole problem? Then on Thursday, the stock market had a strong day. That was pretty much the strongest day of the week. The S&P hit 4150 at the high of the day. Didn't close there, but it got up to that level. The PPI was much weaker than expected, and that was taken as positive. Then on Friday, we were negative overall. We had become a little toppy at that point, so we pulled back. JP Morgan, Citigroup, BlackRock, PNC Financials, they all came out with their earnings, and they were taken as positive. So we're off to a good start concerning the banking sector right now. But what rained on the parade on Friday was Fed Governor Waller, who's a voter on the FOMC. He gave a speech before the market opened, and he said that the Fed hasn't made much progress on its inflation goal, which a lot of people can dispute that because look how inflation's been coming down. He also thinks that monetary policy needs to be tightened further and remain there longer. The markets didn't like that, so we ended up going lower on that comment. But please keep in mind, this was not Chairperson Powell making this statement. We also had the preliminary consumer sentiment reading that came out, and it did show some improvement, but deeper in the report, looking out a year, folks think that inflation will be about 1% higher than it is right now. Here's looking at our poll results. The first question is, concerning the recent banking crisis, do you think there's more to come? 88% said yes. 13% said no. Do you think we'll go into a recession? 90% say yes in 2023. Nobody said we won't. And 10% think we'll go into a recession in 2024. Over on the right-hand side, 50% think the market will be higher, 38% lower, and 13% about the same. Then the week that just ended, 80% said we would be higher, so they are correct, even though it was a minuscule amount. Nobody thought we would be lower, and 20% said we'd be about the same, so that could also be considered a right answer since we had a small upward movement. Here's some information that I just like to include, but it's not really in its own category. We had the CPI come out this past week, and if you go to shadowstats.com, the orange line is what we're told. The blue line is how they calculated it back in 1990. We would be up at around 8.5% to 9% if you calculated it the same way. The scary one is the next chart, where the red line is what they told us. The blue line has us around 13 or 14% if you go back to how it was calculated at that time. Looking at some Isabel Net charts, this is starting to get bearish here. We're seeing a lot of insiders coming in and buying, and it's getting rather extreme, so that could be bearish overall. This next chart put out by Bank of America, they think that we'll top out at 5% with the Fed funds rate before we start coming down. In December of 2024, we'll be at 3.1%, and then in 2025, we'll be at 3.1% also. This is just a forecast, and these change all the time. The dollar, which has been under a lot of pressure lately, where it's really going down when compared to gold and the euro, we're watching this 100 level. So far, right around that level has been support, and the dollar's been able to bounce up off of that. Can it continue? This chart just shows that there's a real surge into treasuries. 2022 really sucked for bonds. People in the stock market had losses. People in the bond market had losses. Well, now that bonds are getting more attractive, we're seeing a lot of money flowing into them. This shows that there's the largest inflow into healthcare since November of 2022, which was not all that long ago. This is more of a defensive play, and if we start seeing a downturn in the economy, people still need healthcare no matter what's happening economically. This is a chart put out by the Fed. It shows that advanced real retail, real means taking inflation into account, and food services, where the sales are starting to come back down after they've been chopping sideways. Then looking at the Real Investment Advice newsletter, this first chart just shows how CPI, even though it's coming down, is still above its long-term trend. This is an updated chart of their weekly look at the market, where they think that we have now confirmed a breakout to the upside. We came down and retested this support level and bounced up off of that, so they're looking more positive. We're also seeing a golden cross with the moving averages, and the MACD on the bottom is also looking more positive. We look at the headline number, and that's what the financial media really loves to report, showing that it is coming down overall, but the blue line is the core inflation, and it actually ticked up in the latest reading. We also compare it here with the sticky price CPI. You take out food and energy, where it's also continuing to go up, even though the green line has declined slightly. The Fed funds rate versus CPI, they're getting pretty close to each other. They had been pretty far apart. The headline here says lots of recession indicators, but there's no recession. We've been talking about this for at least 6 months. It says over the last several months, we have repeatedly discussed the numerous recessionary indicators that have previously preceded a recession. One of those is the inverted yield curve, which I talk about every day in the daily videos. Manufacturing is also slowing down, and the leading economic indicators, which we'll get a new version of that this coming week. However, the financial markets remain bullishly biased despite these flashing warning signs. Here's the NFIB Small Business Confidence Index, which we had this past week. Confidence is really going down, and that could signal some economic problems. Capital expenditures against real gross private investment, both of them are also declining, suggesting that we may head into a recession. This is a historical chart just saying how do stocks perform during recessions. We always see negative returns. We just don't know what size of the return will actually be. On the next part of their post, they say unprecedented. Even in the latest FOMC minutes, the Fed noted the risk of a recession. Pretty much what they're saying here is that this is the first time that the Fed has ever said mild recession in their comments. And the Fed is really in that balancing act right now, because if they keep raising interest rates, that could harm the economy. But if inflation is still strong, they have to raise interest rates to try to get that under control. And they're playing this balancing act back and forth. As we get into earnings season, we are seeing a real decrease in earnings. But then when you look out, a lot of the analysts have much rosier pictures, and that's really producing some kind of a contradiction in the market right now. The black line are corporate profits after taxes, and this red line is called the power line, and they're both going up. But we got quite a ways away from this red line, and now we're starting to come back down. We're also seeing a decrease in overall profits, and that ultimately can feed through to stock prices. This chart looks at net profit margins against sales expectations. The black line are profit margins, and sales are really dropping off. Does that mean that the black line is going to keep going down as well? And that could also put pressure on stock prices. One thing that you've probably heard about is that there's just a few companies in the S&P 500 that are making all the gains right now, with Apple, Microsoft, Nvidia, Tesla, Meta, which is Facebook, Google, Amazon, CRM, AMD, and GE, where the other remaining 490 stocks are not participating as much. And this just measures how things were acting in the first quarter of 2023. Looking at FactSet earnings, don't have any charts here, just a headline. S&P 500 earnings season update. It says overall 6% of the S&P 500 companies have reported as of Friday. Looking at current market valuation, they still have us as fairly valued when looking at everything together. Here's the historical chart. We're still below this yellow +1 standard deviation, so we're not extreme currently. The market valuation models, this is the Buffett indicator. Down at the bottom, they updated by giving a little summary. It's a ratio of the value of the stock market compared to GDP. When we get above the +1 standard deviation, we're overvalued, and we're right below that currently. The price earnings model shows that we are overvalued. We're above this +1 standard deviation. The interest rate model is still fair valued. We're not giving an extreme reading. The S&P reversion model, we're getting overvalued as we're going up. This gray dashed line is the historical trend. When we get too far away from that, this acts like a magnet and we have a tendency to pull back down. But we can be above this for long periods of time. Recession indicator models, the yield curve with so many of them inverted, we are very high, suggesting that we're going to go into a recession. The state coincidence index model is normal. It's really dropping down. When we get above 25 states that have SCI declining scores, that means that we're probably heading into a recession, and we're not there yet. Market sentiment on this chart using margin debt still has us as neutral, and the junk bond spread is also neutral. Looking at our analysis, here's the intraday chart for the week going back to Monday, showing how we did move higher. Then on Tuesday, it was pretty quiet. Wednesday was when the CPI came out and we gyrated higher at first, and then we went lower, came back up. Then the FOMC meeting minutes were released and we tanked after that. Thursday, we gapped higher, and this was the strongest day. We did gap higher on Friday, but then quickly gave that back, but we closed well off of the lows. For the week, the NYSE was up the most, with small caps being up the least, but all indexes were positive. Year to date, the NASDAQ and NASDAQ 100 are in the lead, with small caps in last place. That's something of a concern. Going back to the all-time high, the Dow is down the least, with NASDAQ 100 and NASDAQ being down the most, but they are repairing a lot of those losses. Looking at our different sectors for the week, financials, energy, and industrials were up the most. Staples were negative, as well as tech, but then utilities and real estate were down the most. We also look at the relative rotation graph showing that XLK, which is tech, and XLC, which is communication, they're the strongest, but they're rolling over a bit. Over here in the improving side are the discretionaries. They're rolling over just a little bit. But all the other sectors are continuing to show some weakness as they're going from this square of weakening into lagging. For the week, we had financials, energy, industrials, materials, and discretionary being up the most, followed by healthcare and communication services, where tech, staples, utilities, and real estate were down. Year to date, communication, tech, and discretionary. These are growth areas. They're doing the best, with healthcare, utilities, and financials doing the worst. These are more defensive, but the financials are kind of in their own little story right now. Going back to the all-time high, energy is still in the lead, followed by utilities, and all of the other sectors remain negative. Looking at sentiment, we're getting a little bit extreme, but we're positive right now at a reading of 67. Here's the historical chart. After dropping below 25, we've been climbing back up. When we get above 75, that's when we start to get extreme positive. Looking at the VIX, which continues to drop, we're below 20 with the line chart and the bar chart. The right X bear bull ratio still continues to be about neutral. Comparing cash to the tech sector, we're ticking back down below the Ichimoku cloud, even though it did show a little bit of an advance this past week. The latest reading of active asset managers has us pretty much neutral. When it's 80 or above, that's when we get really excited, or 40 or below. Consumer sentiment did tick up slightly to 63.5, but there's still a really wide spread between how people are feeling and the 2-year yield, even though the yield is coming down. The latest reading from American Association of Individual Investors, after being extreme negative, they're starting to show some improvement. I also plotted this 50-period exponential moving average on here to give us an idea of what is the overall trend. This was a pretty low reading, and that could give some good support to the market. The Ulcer Index is showing, though, that we are still in a complacent environment. Fear is not very high. Looking at the economy, they're going back up a little bit with GDP estimates, with the GDP now. And then the forecasts have us anywhere from about 2.5% down to a little bit over zero. Here's a graphical look at that. We're focusing on this last column here where we have positive GDP. Looking at the spread between risky and not as risky loans, if we were having more problems, this would really be going up. The financial conditions index also is ticking up, but we're still under this black line. This chart has not been updated when we show that tightening standards continue to increase with banks. When we get above the red line, the real-time SOM recession rule indicator, that shows that there's problems, but it hasn't gone even above the black line yet. The smoothed U.S. recession probabilities also dancing around the black line. We're waiting to see if it'll go above the red line. The Brave Butter Kelly's leading index is going up, but it's still below this black line. And we're seeing a real drop-off. The Fed was making a nice lot of money between their liabilities and capital. But then with this whole banking crisis, it just really shot down. Looking at inflation, the inflation nowcasting did drop down a little bit. Looking at the Fed, right now there's a 78% chance that the Fed will raise interest rates 25 basis points. The Fed balance sheet, after coming down through quantitative tapering, shot back up during the banking crisis, and now it's starting to come back down. Here's the balance sheet showing the rate of change, where we're dropping down below the zero line, but it is starting to tick back up. Now, looking at breadth, we're above the moving average based on price, and we're right on the moving average based on volume. The advanced decline ratio is declining, but still above zero. New highs, new lows, we're still hanging in there okay with our 4-period and going back with our 10-period moving average. Accumulation distribution remains above an advancing moving average. Here's the condition of the trend showing the ADX continuing to weaken. It's trying to turn back up, but it's still below the moving average, and the green line is on top, but the ADX is below 20, and we're seeing almost the same thing on the daily chart, but the green line has been a little bit more aggressive, even though it's declining as of late. Our Arun is still positive, even though it ticked down slightly. We're above zero with the oscillator. That's positive. No signals being generated with the mass index. Looking at the daily chart, we're starting to make a series of higher highs here. And what I've been pointing out in the daily videos is if we keep going up, we have another resistance level going back to this previous high. And we also have this upward sloping trend line, and they may converge in each other and produce some pretty significant overhead resistance. If we do go up, chances are that we might be very overbought at that point and could really turn and push us back down. Whether it's going to turn into a trend reversal or not is yet to be seen. But on a daily chart, we're still above the 50 and 200 period moving averages. Down below, we can also see where volume continues to be below average. We're still on the upper side of the trend channel going back to 2009. We're above the pivot point on the monthly pivot charts. We're above the 50-period simple moving average. That's positive. The long-term trend, after giving a recent golden cross, is still hanging in there, positive. The bullish percent index, and we're seeing almost the same reading on the daily chart. We're above 50 and advancing, so that's positive. The Chaikin oscillator continues to be positive. The Chaikin money flow is pretty much going sideways. The force index is still above 0. That's positive. The McClellan oscillator, after getting extreme, came down and still is continuing to fall, but it's positive overall because we're above 0. The summation index based on price and volume have crossed above 0 and are advancing. That's positive. Looking at our oscillators, the slope is turning up. The TSI is going up, the MACD is going up, the PMO, the PPO with our intermediate term, and our long-term oscillators are continuing to be positive, but the KST is rolling over slightly, but it has not gone below its moving average. The swell trading oscillator, after getting extreme based on price, has come back down and ticked up in this past week. We also declined based on volume, but we're still positive overall. Here's the PMO showing that it's positive, and we're above 0 based on price and volume. Our PMO steady after getting extreme with the rising PMOs. It's starting to go back up. We're starting to get extreme positive with the buy signals, and we're still going up with the PMOs that are above 0. RSI is above 50 and climbing. That's positive. Special K continues to fall, but we have not gone below that moving average yet. The Stochk RSI is extreme positive, and the Williams percent R is also extreme positive. The Vortex is positive with the green line on top. Ultimate oscillators above 50 and advancing, that is positive. The money flows above 50 and advancing, that's positive. The Bollinger Bands are not giving us an extreme reading. The rate of change going back 1 week is positive, and we're showing a lot of improvement going back 50 weeks, and we're just getting ready to cross above the dashed line. That's showing some improvement. The Copic curve is giving us a buy signal, and we're also working off a buy signal on the daily charts. Looking at our fib retracement levels, we're still above these moving averages, and we're still above this 38.2% retracement level. We're also above the 200-week moving average, so this chart is still hanging in there positive. Our different charts, the Heikin Ashi remains positive with open candles. The Kegi has a black line pointing up, that's positive. The Renko has open blocks, that's positive. The ease of movement, which tries to measure the path of least resistance, not really regarding for volume. On a 1 week basis, we did decline slightly, but we're still above 0, even though we declined on the 14 week. The point and figure chart didn't add anything new this past week, so it's still hanging in there positive. The 3-line break is also positive with open bars. Looking at our trading systems, the Elder Impulse system remains positive. The parabolic SAR. This was a big one. We had a dot underneath a week ago. We still have a dot underneath. Looking at the broad market, here's the S&P and the mid caps, which are showing a little bit of weakness, and the small caps are showing even a little bit more weakness. All stocks continue to be positive and are in an uptrend. The mid caps showing some recent weakness, even though we're positive overall. And the small caps are a bit of a concern. They're still in an uptrend, but we have really been falling, and now we're chopping sideways. The Dow remains in an overall uptrend. The NASDAQ, after giving a recent golden cross, is in an uptrend, as is the NASDAQ 100. The Wilshire is also in an uptrend. NYSE, after giving us a golden cross, fell back and is trying to now bounce up. FANG stocks are also in an uptrend. ARK still is in a downtrend. If we wait long enough, we might see a golden cross soon. The big software companies, recent golden cross in an uptrend. The bank index showing a lot of weakness here. The MACD continues to decline. The RSI is also giving an extreme negative reading, so we may see some kind of a bounce out of this. Looking at the deposits for all the banks, and this is why there's a lot of pressure under bank stocks, you see how the deposits have really gone down overall. People are not confident in banks right now. Looking at Dow theory, we've been holding up okay with the Dow. The transports, though, have been really lagging, and we're seeing okay movement with the utilities, but some recent weakness overall. We're seeing a negative divergence between the Dow and the transports currently. Looking at the broad market, the CRB index continues to be in a downtrend. Copper is still in an uptrend overall. Gold, which is getting a lot of press right now, it's looking at overhead resistance. Now, this is not the gold futures contract. This is the gold ETF. So you're going to see some discrepancies between the two. And it's showing that as gold now seems to be the cool place to be, people that got screwed over in Bitcoin are now starting to jump back into gold. And just about at that time, when everybody's talking about it, that's when we hit some kind of at least short-term top. We'll have to see if it can carry through to the upside. Silver has also been doing quite well lately and is in an overall uptrend. Oil, after the OPEC came out and said, we're not going to produce as much oil, that shot oil prices up. The dollar continues to be in an overall downtrend, but we're still above 100. Looking at bonds, and here's where I have some additional charts. The bond ETF continues to be in an uptrend. Here's looking at the 5-year yield, where it's really been going up overall, and now we're starting to cross below this moving average. The special K, which is a long-term oscillator, is now crossing below the moving average. That could suggest that interest rates may be getting ready to go down. The KST is also rolling over a bit and is negative, but it could be getting ready to turn back up. So we'll keep an eye on this chart. Here's another look at the 5-year yield, showing that it's still in an overall uptrend. On a short-term basis, it's rolling over. We're negative in the intermediate term, and we're just beginning to go negative in the long term. This looks at the 10-year bond. Now, this is based on price, where bond prices are just coming back up above the moving average. Then we take a ratio, the financial sector to the bond ratio. Financials have really broke down when compared to bonds, but they're showing some improvement. However, the long-term KST ratio still shows it in a decline. Here's another look at the bond ETF. And then we have the Fidelity Capital and Income. That's high yield bonds like junk bonds. And it compares them to treasuries. And it's showing, again, this is the same chart where we're coming up to the moving average. And the high yield bonds are outperforming treasuries. And they're starting to show a longer term climb with the KST. Here's an ETF of longer term bonds where we're still in an overall downtrend. But on a short term basis, showing some improvement. Intermediate term, we're going up. And we're just looking at a potential cross longer term. And then here's a look at the daily chart of the yields where we have been going up over the past few days. Then I want to show you a new chart. I finally found the MOVE index at stockcharts.com. Well, it turns out they just recently added this to their indexes. The MOVE index is the VIX for bonds. And so that's why I have the MOVE index up here and then the VIX down below. You can see that there's a pretty strong correlation between the two. So if the MOVE and VIX are going up or down, they're tending to do it in the same overall direction. But now that I have access to this, I can apply some additional studies here to get some more insight as to what's happening with bonds. Since that right now is the focus of the market, it may be more of a focus, especially if we do end up heading into a recession. Here's an international look at yields, how they've been ticking back up with the US, UK, and Germany, and then Japan's its own little story down at the bottom. Some relative studies, intermarket analysis, going back to the beginning of 2022, oil is still in first place, followed by gold, and then the dollar, where stocks and bonds continue to be negative. The bonds to stock ratio on a shorter term basis still has stocks outperforming or bonds underperforming. Then on a monthly basis, stocks are outperforming bonds. Gold, which has been doing quite well to the US dollar, is in an overall uptrend. Then gold to the S&P is still showing that gold's outperforming the S&P. Low volatility stocks, which were the place to be in 2022, are now starting to see less favor, and we're seeing a death cross with this ratio. Growth versus value. Growth is still in an overall downtrend, but showing some improvement. The NASDAQ 100 has been outperforming the S&P 500, and we're now seeing a golden cross with this ratio. The S&P 100 has been outperforming the S&P 500. It's still in an overall downtrend, but could be getting ready to give us a golden cross with this ratio. Discretionary has been underperforming staples and trying to show some improvement, but not seeing an awful lot of follow through currently. Energy, which was really strong in 2022, is now starting to underperform, and we're seeing a death cross with the ratio when compared to tech. Looking at some of our other longer-term indicators, the NYSE breadth thrust, after generating a signal in October of 22, it's now shooting up. Looking at 1, 2, 3 years, even though you roller coaster your way through it, this indicator ends up having a perfect track record. Then looking at our momentum, we're trying to determine if the breakout above the recent trend line is legitimate or a fake out. Back in 2000 and 2001, we did break above this trend line only to see prices really fall down after that 2 times. Well, if you look down at the bottom, see what the MACD was doing at that time. It was showing improvement, but then it was well below zero both times. Now we go ahead to 2008. We saw another potential breakout here. The MACD was going flat, and that ended up leading to much weaker prices. We now go to the present day where we're above this trend line. It looks like we're breaking out above that. However, this time the MACD is above zero and advancing, so this is showing much more improvement. If we start to fall, we'll be watching this MACD. We'll also really be watching this trend line. What's our outlook for the upcoming week? Here is a list of all the different economic reports that will be released. The things to watch are the technicals, as you can tell, are pretty much turning more positive, and we're seeing a lot more positive action on the daily charts, but we're overextended to the upside, so we might bounce sideways to slightly down. But if we do really start to fall, we'll be looking to see if the climate does change. But on the weekly charts, we're also looking a lot more positive. The markets continue to be fixated on inflation and interest rates. Earnings will be coming out, any Fed speak that we may be getting. And then we're watching to see if any more banking information hits the news cycle. We do have a number of Fed speeches that will be given during the week. The one to kind of watch for is Governor Waller on Thursday. He's the one that made the comments before Friday's session that kind of freaked the markets out. Looking at the stock trader Almanac statistics, here are the statistics for April overall, which tend to be quite positive. Then we look at April 17th, where we're up with the Dow 71.4% of the time. We're neutral to positive with the S&P, and we're negative with the NASDAQ for Monday's session. But we tend to be positive overall for April. But we're now starting to enter into the second half of April where things might turn a little bit more dicey. This is the yearly chart that I go through from time to time, just adding to the positive backdrop that applies to the whole year. Here's the chart showing this green line that we are experiencing positive seasonality. This next chart with the gray line shows the same thing in a pre-election year, and this is also showing the same thing overall. We're on the 11th trading day on Monday, and we tend to be positive with the S&P in a pre-election year. Looking at our scenarios just for Monday, can't really go with the down one because everything's pointing up. But on the daily charts, we are working off being overbought, so we may see some more weakness in that area. Hard to go with the up one because we're not really trending unless you're super aggressive and much longer term and you feel confident about things. So we're still having a tendency to go with the sideways trend overall. The ADX is strengthening, meaning it's above its moving average on the daily chart, but we're still below 20. The positive line is on top, but it is declining. That is slightly different from the weekly chart that I just showed you. Thank you. I hope you found this helpful. I will be posting the intermarket analysis video and the deep dive video as soon as possible. Please feel free to check out the daily videos. That is where I do my most in-depth analysis from day to day, where the weekly videos are designed to give you a bigger picture look. And for some of you, that's fine. But if you like more in-depth coverage, please check out the daily videos. I try to keep them between 20 and 30 minutes each day. And even though they're a little bit longer, I try to go as in-depth as possible to give you a good overview of what's actually happening. So I hope you're having a really nice weekend, and I will talk to you in the next video.